Usually, there are 3 to 4 important key drivers that will influence the performance of a company. Today, I'll identify the 3 key drivers that will decide Tesla's stock price. I'll look at where Tesla struggles with competition, how it plans to improve margins, and what would need to happen for Tesla to achieve its ambitious long-term goal of growing 50% per year until 2030. And I'll start with the third most important key factor, which is the pace of the transition towards green energy. The government is the conductor of this green energy transition and supports both the consumers in form of subsidies as well as manufacturers with grants for building factories. The new Inflation Reduction Act will authorize $391 billion in spending on energy and climate change in the US, with investments that will spur consumer demand for EVs until 2032. This is a strong tailwind for the transition towards a sustainable energy future. The main purpose is to bring the battery production back to the US, since China owns most of the market for the necessary raw materials for battery production. And it just so happens that China is leading the transition towards green energy. Some sources estimate that 35% of all cars sold in 2023 could be electric or hybrid in China. In February 2023, sales of new electric and plug-in hybrids grew faster than the overall market, up 61% on a yearly basis. However, this came in spite of a major shift that happened at the end of 2022, when the government stopped some significant incentives granted for electric vehicles. Tesla is the third biggest player beyond BYD, who owns around 27% of the electric and hybrid market, while the second company is Wuling. When considering the fully electric vehicles, Tesla's market share dropped from 15% in 2021 to 10% in 2022. Although active mostly in China, BYD is the global leader in electric vehicles, with 537,000 units delivered in the third quarter of 2022, while Tesla came in second with only 343,000.
We have a lot of respect for the car companies in China. They are the most competitive in the world. That is our experience, and the Chinese market is the most competitive. They work the hardest and they work the smartest.
Next, Europe is the second biggest EV car market in the world. Under the new European ban, car makers are required to reduce the emissions of new cars by 55% by 2030, with the final goal of a 100% cut set for 2035. The development of a more localized EV supply chain, especially for battery production, should be a tailwind for European vehicle electrification, particularly when combined with the aggressive government policy. That's why Tesla expands the capacity of its Gigafactory Berlin at a fast pace. Moreover, the European political leaders have set ambitious goals for producing the battery cells entirely in Europe by 2027. Tesla was the European global leader for 2022 with 9% of the electric and hybrid market. Next, looking at the United States, Tesla is the clear leader with 64% market share. Tesla has the biggest market penetration in the US with around 3.5% of the total cars sold. Here are the best-selling EVs in the US, with Tesla completely dominating the market. Although capturing market share is really important, the operating margins are more critical, so that's the second factor. They tell us how much of the revenue can a company transform into profits. But first, here's Tesla's incredible growth trajectory by numbers of cars sold. Moreover, Tesla became GAAP profitable since 2020, as the company's execution has been phenomenal. However, the most important for a manufacturing company is the gross margin, which is revenue minus cost of goods sold. Tesla is the global leader in terms of gross margin at the end of 2022. Additionally, Tesla's operating expenses have been kept in check really well, which proves phenomenal financial discipline that will further improve the operating margin. As a result, based on its margins advantage, at the end of 2022, Tesla made a shocking decision to cut the global prices for its EVs significantly. This signals two things. Firstly, Tesla wants to gain more market share, especially in China, where the company doesn't lead the market.
We're taking a view that we want to keep making and selling as many cars as we can. We believe we can keep pushing for strong volume growth while retaining the industry's best operating margins.
Moreover, a difficult macroeconomic environment is on the horizon, as Tesla anticipates a demand slowdown. Secondly, the company believes that the supply chain has returned to normal to a large extent, and that raw materials will become cheaper in the next couple of months.
There is, with respect to cost structure, somewhat of a lag effect where there's latency in the supply chain. So the supply chain will take a bit longer to reduce costs than we'd like.
Moreover, besides the price cuts, the mix of cars sold is also really important, since Tesla's most sold car is the Model Y, which has a lower gross margin than Model 3. Additionally, vertical integration will be key, lowering the cost of goods sold. By eliminating the need for third-party suppliers, Tesla will improve the manufacturing process and lower costs. Lastly, Tesla has great optionality with the FSD, which the company can upsell to every single car build.
Every time we sell a car, it has the ability, just from uploading software, to have full self-driving enabled. And the full self-driving is obviously getting better very rapidly. That means that there's millions of cars where full self-driving can be sold at essentially 100% gross margin.
The main reason why Tesla's margins are above the industry is the constant improvement in the manufacturing process. Moreover, the main focus at Tesla's 2023 Investor Day was the further improving of the manufacturing process in order to cut back on cost even more. Tesla presented a fundamental change in the assembly process which puts the car together differently in an unboxed process. Summarizing the company's projections, Tesla set a bold objective of lowering the cost for the next generation vehicle by an impressive 50%. But one short-term struggle will be regarding semiconductors, which remain the primary constraint for auto volumes. The number of chips available for vehicles remains limited because they are typically built on older architectures. Semiconductors might remain an issue in 2023, since generally a Tesla with FSD uses significantly more semiconductors than an ICE vehicle. Surprisingly, Tesla's lead in the manufacturing process has been recognized by other industry players like the Japanese giant Toyota, which called the Model Y a work of art. Lastly, as the manufacturing process becomes more efficient, building new gigafactories will require less capital investment. Right now, Tesla has 5 gigafactories, out of which Gigafactory Texas and Berlin are still developing, as the company just announced it will build a new gigafactory in Mexico. Tesla expects to grow its number of new cars sold around 50% every year by 2030, and to achieve its target, and assuming that each factory can produce up to 1 million units per year, it would require 15 additional factories to be ramped between now and 2030. Lastly, another complementary piece for the transition towards green energy is the supercharging infrastructure. As the cost for supercharging dropped heavily, Tesla is the leader for the direct fast charging stations in the US. Lastly, Tesla has recently opened a charging network to other EVs, as the government offered the company a subsidy of $7.5 billion. Next, to understand if Tesla will reach its long-term goal, we need to look at the single most important factor, which is the cost of electric batteries. The Institute for Energy Research estimates that in 2022, batteries accounted for 30 to 40% of the cost of an electric vehicle, and Statista estimates that it won't drop below 20% before 2030. Electric batteries are expensive mostly because of the high cost of raw materials. It's expected that the demand for lithium-ion batteries will grow at a phenomenal 32% CAGR between 2020 and 2030. Lastly, because of this trend called green inflation, we saw the first battery cell price increase in a decade, around 7% in 2022. As a result, this was the biggest limiting factor for Tesla's manufacturing.
For the longest time, we've been constrained on total cell lithium-ion production output. That's the actual limiting factor for new models, not anything else really.
As a consequence, in 2020, Tesla made a decisive move that would severely impact its long-term growth strategy. Tesla decided to bring in the battery production in-house, and this is a move downstream on the supply chain called vertical integration. Moreover, besides creating their own battery cells, Tesla isn't afraid to go down on the supply chain even further and start mining for rare earth oxides if needed.
We'll do whatever we have to. And whatever the limiting factor is, we'll do. If we do not artificially constrain ourselves, if we have to go mine, we will mine.
Vertical integration has been the way to go for electric vehicles manufacturers. This process brings a lot of benefits like more control over the production timing and the product quality, and less dependence on suppliers. The only downside is the significant capital investments needed. Here's everything that Tesla builds in-house as of now. As a way of removing the high supercharging time and cut back on cost, Tesla came up with its innovation of the tabless cell system. Besides rearranging the cell tabs, Tesla will also replace graphite, which is expensive and in high demand, with silicon, which is much more abundant. To sum up, Tesla anticipates that the creation of in-house battery cells will lead to a 56% total cost reduction. Still, it's important to note that while Tesla is ramping up the internal production of battery cells, it won't dump its suppliers.
We will continue to use other cell providers, just that the demand for lithium-ion batteries is quasi-infinite and will be for quite some time. We feel we can scale a lot faster using both suppliers and internally produced cells.
Tesla only produces 1,000 battery pack cells per week, but a new investment in the Nevada line is set to multiply this by 30.
We're going to go basically pedal to the metal as fast as humanly possible to get to 1,000 gigawatt hours a year of production in the US, vertically integrated.
To conclude, Tesla might be the perfect mixture between short-term execution and long-term thinking. While its margins might suffer in the short run, especially if a recession materializes, Tesla is making its long-term focus a priority and reinvest to create it as fast as possible. That's what great alignment between short and long-term vision looks like. Next, I will be doing a complete financial analysis of Tesla, where I analyze its execution from a financial standpoint and if the stock is a buy. Until next time, keep crushing it and subscribe.